Hey, welcome. This is a new series, everybody. Brand new series, all about alternatives, right? You know I don't like that word, but hey, this is what it's about, alternative series. We're going to have guests coming in from all walks of life, from our forex, our commodities, to real estate, to this lovely lady in front of us who you cannot wait to hear her story and what she's got going on. But that's what we're about in this series. So if you have questions, if you ever want to know what alternatives are about, this is where you want to go. So lay it on me. Let lay it on all of us. What do you have going on? Who you are? What's going on with your new company and where you're at?
Sure. So I'm Shana Orczyk Sissel. I'm the founder, CEO, and president of Banrion Capital Management. I launched the firm in September, and we officially launched last week. So we're excited. We got some cool things going on, and the focus of our firm is to help advisors and individual investors get not just the ability to access alternatives, but everything they could possibly need to scale investing in quote unquote alternatives. And you and I were just talking about this before we went live about the definition of alts. They call me the queen of alternatives, and I didn't give myself that nickname.
And I want everyone to know that wasn't an industry thing. We've turned her that. That was not her own thing.
That was not my thing. I was given that nickname by Cynthia Murphy, who's the director of research at ETF Think Tank. So I always like to caveat that, because I don't ever want anyone to think that I just gave myself that nickname because it's
right.
from marketing.
Who does she think she is, right?
Yeah. To your point, that was an industry thing. That was others in the industry recognizing that I have some expertise here. It's something I'm really passionate about. And so it was something that I kind of wear as a badge of honor, like recognition for the fact that my hard work over the last 10 plus years in this space is seen and respected by my peers. And that's cool to me. But, it's important to kind of point out, you and I were just talking about this, we call them alternatives, and it's so not the right term, but there's also nothing else that you can really think that would encompass the entire space.
Right.
And basically all alternatives are things that aren't traditional. They're the alternative. My friend Phil Huber, who wrote a book called The Allocator's Edge, he also shares my passion for the space. He has always said, and I love this because I think it's totally correct, is that it's not what they are, it's what they aren't. Because it's a lot easier to define what they aren't. And what they aren't is your traditional long-only stocks and long-only bonds. If it's a publicly traded stock and you're only going long, or if it's a publicly traded bond and you're only going long, it's not alternative. Everything else, literally everything else, is alternative. So, in that respect, it's a huge universe. It's extremely diverse. It includes a whole gamut of things from private equity and private credit to hedge fund like strategies, long short, market neutral, global macro, managed futures, real estate, like physical real estate, because REITs are traded publicly as stock on exchanges, but like physical real estate, private real estate, music rights,
art,
antiques,
right,
art,
all
wine,
of that,
cars. That's all alternatives.
Yep.
So it's a pretty big universe of things, and I think that's what makes it so intimidating. And it's what I have focused my entire, 10 plus years, last 10 plus years, since I was introduced to the space in 2007, helping people kind of figure out how to, swim through this sea of options and understand how, people always talk about alternatives as diversifier, alternatives as, excess returns. Yeah, you can find that in the universe, but there's also a whole universe of other things you got to wade through in order to get to those things. And that's the intimidating part.
Absolutely. But I mean, let's be real. We've been in this industry. We've dealt with people who have a lot of actual wealth in terms of money figures. wealth is a whole different conversation that I'll get into later. But in terms of money, people have a lot of money, build majority of their money from the alternative space.
Absolutely.
I don't know one planner on this earth that can say you're going to be rich and have a lot of money by just doing the traditional way. No, it's there. It has its purpose. It's important. Don't get us wrong. But the alternative space is where you make your money. Like, that's where it's at. And it's really tough for everyday people to understand that part because of whether it's our regulations, our marketing of awareness, or even just the communities and networks that they have just aren't involved. And that's what you're here for. That's what we're pushing as hard as possible. Within that scope, what do you think is the initial issue, problem in our alternative space to become more aware? Because really, if you think about it, when you said traditional and it's really just long stocks and bonds, that should be the alternative because it's so small. Everything else is so big, right? What do you think is the one issue that's causing that?
So I don't think it's one. I think it's two.
Nice.
So the first issue is, I think, performance. Because it is such a vast universe, it's hard to differentiate and decide where you need to be and have appropriate performance expectations of why you're investing. And I think a lot of people look at alternatives and compare it to the stock market, and they can't. And the second thing is, I think, access. So you pointed this out, traditionally alternatives have only been available in private markets. And, I'm going to throw a bunch of numbers and letters at you, things like 3C1 and 3C7 funds, which are just fancy ways of saying only available to qualified clients and accredited investors, which means that in order to invest, you have to meet certain hurdles. And if a firm has these types of funds, they can't actually actively market it. So you kind of have to find them and know about it, and they can't really solicit. So that makes it hard. That's why all these access platforms exist, to try to help resolve that issue. But again, this is a really, really big universe, like 10 times bigger than your traditional equities and fixed income space. So very difficult to find because there's not as high barriers to entry. You don't have to do the extensive regulatory filings that you need to in order to be in the more public space. And there's a reason for that. But I think that's changed. I like to always give this history lesson, and anybody who's heard me speak before is going to be bored to tears because they've heard it before. But in 2007, the SEC changed the rules as it relates to what is called the 40 Act, which is the regulatory framework that allows for mutual funds and ETFs to be available to the masses. And prior to 2007, the SEC really restricted the ability for funds to be able to use shorting and leverage within an ETF or a mutual fund. In 2007, when they relaxed that rule, there was this enormous influx of every asset manager in the world launching 130/30 and 120/20 funds. And 130/30 became the number because the SEC relaxed the rule, saying you could leverage and short up to 30% of your net asset value. So it allowed for hedge fund-like strategies to become available in mutual funds, and then eventually ETFs, as non-transparent rules became more allowed for funds that were shorting to feel comfortable, doing things in an ETF. So now there is access for everybody. And then now we have a lot of platforms, and we're talking about tokenization of potentially private product. There's new interval funds that kind of allow for, everybody to be able to access less liquid securities, assuming that they're comfortable with the less liquidity. Right. I think that's another stumbling block in the space, is that you have to be comfortable with the fact that you can't just, at 1 p.m. on Thursday, go into your account and sell something and have the money in your account 2 seconds later. Right. Many of these things are not quote unquote liquid. You can't do that. It's a little bit harder to sell. And so you have to be okay with knowing that your money isn't easily accessible, if you will. But interval funds now exist, allowing for investors to take advantage of less liquid markets. And there's alpha and illiquidity. I say that all the time. Being willing to invest in something that isn't daily liquid allows you the opportunity to invest in markets where you can really make a lot more money. And that is why I mean when I say alpha and illiquidity, private equity, private credit is the perfect example of that, because I don't really think that they're diversifiers in the sense that they're not reducing your equity or fixed income beta. They're just a better mousetrap to get better returns because you're in a less efficient market, but they're less liquid. So you get the alpha somewhat from illiquidity. And so these are things that now everybody can invest in. There's crowdfunding if you want to be involved in venture capital. There's crowdfunding platforms that anybody can participate in. There's crowdfunding lending platforms, and everybody knows them. Peer-to-peer lending, anybody can participate in. So, there's a lot more opportunity for the average individual, the average investor, to be able to participate in the space. And again, it's a huge sea of possibility. And so my firm exists to help investors wade through that. And our goal is to make alternatives available and accessible for everyone. So part of what we do is access. We focus more on emerging managers, smaller managers, because quite frankly, if somebody wants to get into Blackstone, I can make a phone call. It's not that hard. All these access platforms that focus on the Goldman Sachs, the Morgan Stanleys, the Blackstones, and the Carlyles, I hate to tell you folks, it's actually not that hard to get into those funds. You know the right people. The only thing that you really get from the big access platforms is lower minimums. But again, if you know the business, you also know that you can work that out.
Right.
There's a lot of opportunity there. And where you really find opportunity is in the smaller managers, the emerging managers. There's plenty of academic research that shows in the space of alternatives, actually, smaller managers do better. The only place that's not true is private equity, where scale is important. But in pretty much anything else, you want to have smaller managers, because especially when you're dealing with less liquid, more esoteric stuff, that you can't really scale that. You're never going to have huge funds of music rights because the actual universe of music rights to invest in is pretty small. So you can't put trillions of dollars into that space. Yeah. So you're never going to find a multi-billion-dollar fund that invests in music rights or wine, or you know what I'm saying? So there's a lot of opportunity, and our goal at Banrion is to help advisors in particular that deal with traditional, everyday, quote-unquote, Main Street investors to gain access to that. Because I think ultimately, when you think about education of how to help people build wealth, and you did a great job talking about the difference between savings and wealth. They're not one and the same. We, as an industry and as a society, do a great job telling people that it's important to save. But you don't build wealth. You don't break the circle of poverty because you saved. You do it because you invest. And to your point earlier, the way you make and build wealth is not necessarily through the stock market. Now, that's certainly a better option than just putting it in like a savings account at your bank. But if you really want to make a difference, you have to go into the alternative space, into this less liquid stuff. And I think the most obvious example of that, which is sort of like the training wheels, if you will, of taking that jump, is like, you buy a 3-family home and you rent 2 of the apartments and you have the cash flow. Like, that's kind of the training wheels version of it.
Right.
It's having that passive income. It's the same idea.
Yeah, absolutely. And I wanted to get your opinion on this after I go through it, but a lot of advisors, older, ones who aren't familiar, even younger ones that come from your BD side of everything, and then, individual investors and just normal people believe alts are always higher risk. They're, crypto-esque, right? Where the risk is so high that why would I get involved? And part of that is the liquidity part of it. But again, I want your opinion on this, because my opinion is that's wrong. There are a ton of alts, so many, I don't even know how many, millions of alts that are actually less risky than the stock market in itself as a whole.
It's total nonsense.
Yeah.
Yeah.
And why is it like, I'm going to let you go on that because I could rant about that for hours, but
All right.
I want you to go on that one.
Because the guys who make the headlines, which is like the 0.1% of all alts, the guys who either make the headlines because they made, 1,000% one year, or that they blew up one year. That's why. Those are the guys you hear about, and it's like anything. You want to take everyday life. You think the world's scarier and less safe today because we have a 24-hour news cycle that focuses on every bad thing that could possibly happen. And when you have 24-hour news cycle and you can get information really quickly, it really does look like everybody's dying because they were trying to take a selfie and fell off a cliff. Like, that might happen 3 times a day across the world.
Right.
But because all 3 times are in the news, it feels like it happens all the time. It's that kind of thing. It feels that way. I spend a lot of time, and this is why I have a job, and this is why I have a passion for this, educating advisors on the fact that that's not true. I can put together for you the least efficient alts portfolio. And when I say least efficient, it's not the optimal way to get exposure, but I can put together a model, a portfolio using just 40 Act product, just ETFs and mutual funds. And if I can show you, and I actually have this data, that if I take my little 5, fund portfolio, and you used it with your traditional 60/40 at a 20% clip, so you have $1 million, 800,000 goes into your 60/40, 200,000 goes into my little alts portfolio, you'd get improved returns. Nothing sexy. You might not even notice 10, 20 basis points on an annualized basis, which actually does add up quite a bit. But to your point about risk, you would have reduced your risk. It wouldn't have increased the risk. It would have reduced the risk of your overall portfolio. And while I know crypto is extremely controversial, a very tiny allocation to crypto, 1% or less, could also do the same because it's not correlated to traditional markets, and you have huge potential upside. And if you have a small enough position, that huge potential upside can add substantially to your portfolio returns. But because it's such a small position, if it went to 0, it would have almost no impact on your portfolio. So, from my standpoint, having that diversifier, that no correlation part of your portfolio, and just to be clear, I don't have crypto in my model, but I'm just kind of throwing it out there because I have seen some good work done by a firm called Bitwise that actually shows this. And Bitwise is one of the few crypto companies that I think is one of the best in the business. They don't try to blow smoke up your ass, for a lack of a better term. And they're honest about it. And they really do focus on education. But they have some great stuff that shows like a 0.5% position in crypto can make a huge difference with virtually no downside because the position is so small. At the end of the day, if you pick the right alternatives and you know how to build an alternative portfolio, and that's the key. I think the reason why advisors get so caught up on, poor performance, these things aren't great, they're too risky, is because they chase returns. It's natural. We all, to some extent, chase because we don't notice until it's
a little late.
Ooh, look at that.
Ooh, let's get in. Yeah.
So, in essence, what happens is you chase what works, and then it doesn't work. But then if you think about building an alts portfolio the way you think about building fixed income or equity, you would never sell your value fund because it was underperforming. Like, I've never heard of that. Like, people are like, value's not working, but you don't all of a sudden see a mass exodus of value because it didn't work, and you're not freaking out about it. You know that, like, this is how it happens. Growth and value tend to have different cycles. You can never really determine which one's going to do best, so you have them both in your portfolio because that's how you diversify. It's the same thing with alts. We don't teach advisors how to build alt portfolios like we teach them how to build equity and fixed income. And so they buy a long short fund thinking it's going to, a directional long short fund, thinking it's going to diversify, and it's really just equity beta. So when you have a straight up bull market, you're like, why does this thing suck? Well, because it's short stuff. It's
Right.
meant to hedge.
It's
And then
meant for that.
right. And then when the markets go down and it's negative, maybe not as negative, but it's negative, you're like, well, why did it save me? Well, it did, but it's still directionally long equities. And
Right.
so it's going to have some exposure there versus, and then they only have the one. Like, oh, that's my 20% odds. Well, no, that's not how it works. Just like you have to build fixed income and equity with like lots of building blocks, it's the same thing in alts. Like, you're going to have a market neutral fund. You'll probably have some sort of credit arbitrage fund. You'll have a global macro fund, which is super uncorrelated to equity
Right.
markets. You'll have a managed futures fund. Maybe you'll throw in a hedged equity fund, depending on whether or not you think the markets might be going up and you want to have a little bit of exposure there. And that's how you build an alt portfolio. It's not one fund at one time and the fund that did well before. No, it's the same way you approach fixed income. You're going to have high yield, you're going to have investment grade, you're going to have floating rate. And you understand that in the totality, it makes sense. Same thing with alts. Same thing.
Yeah, absolutely. And even to throw, okay, let's go back to your point. You said 20%. Do you believe 20% should be in alts, or what is your philosophy and number?
So overall, the research supports a minimum of 20%.
Say that louder, just for everyone in the back. Can you say the minimum again was what?
20%.
Okay.
Maximum of 30. That's the realm, and that's based on research done over decades using institutional models, because institutions average about 23% in alternatives on a broad basis. Now, endowments tend to be like 50%
Right.
because they don't have liquidity needs. But the average pension fund has somewhere between 20 and 30%. And the reason why the 30% is kind of max is because you're talking about anything more than that makes your overall portfolio relatively illiquid, and then that's where it becomes more difficult. So 20 to 30% is where you get your maximum bang for your buck, where you can get, better overall portfolio returns with lower risk. Anything other than that, you might actually not improve returns and you might increase risk, because as you broaden your alternative landscape, the chances are that you're going to, we use the term in the institutional size risk budget, take on something riskier. And then add more risk to your portfolio. So you're not really adding anything. And if you think about just diversification as a rule, it kind of works the same, with stocks. Like I was reading something from somebody from Alpha Architect that posted this yesterday that showed that like beyond 20 stocks, the diversification benefit of each additional stock basically is nothing.
Right.
And it's the same with alts. So 20 to 30% is the number. Minimum of 20, maximum of 30.
Yeah. And are you including kind of the private side in that too? Or are we, because most of the data, and I want everyone to know, like when we speak about some of the data, a lot of the private data we just don't get, because why? It's private. Like that's not always going to be disclosed. So I believe that number's probably higher if you include private. But in your conversation, are you thinking 2030 total, which is private as well, or not?
So this can be debated. I consider private equity and private credit equity and fixed income.
Okay.
So I actually don't include them in that 20 to 30% bucket.
Love that.
But you're dealing with illiquidity.
Yep.
So it becomes a question of kind of like the endowments, right? How much illiquidity can you have in your portfolio? But to me, private credit is no different than public credit. You just have some better opportunity to make more money in a market that's less efficient, that has, to your point, less information. So it's an information edge that you get, and so you can make more money. And the same thing with private credit. It's the exact same thing. It is an information edge, getting information that is not publicly available that allows you to have that, but it all comes down to the liquidity aspect of it. And I would say in the space that I play, which is working with mass affluent advisors and their clients, they would never be comfortable with more than 30% total, including private equity and private credit in their portfolio. So I typically recommend that 20% in like my kind of alts portfolio, that diversifier portfolio, and an additional 10% in private equity and private credit. It all comes down again to liquidity. More affluent folks who can tolerate less liquidity should probably have more like 20 to 30% in that private equity, private credit bucket. But I generally don't deal with those folks. And also those folks tend to be able to access more things in the venture capital space
Right.
than the average investor. Really, that is the one space that is exceedingly difficult to gain access to. I actually have one of my strategic partners is this amazing firm called Vested, which has the best mousetrap, in my opinion, to gaining access to venture capital in a way that feels more comfortable and more intuitive for the individual investor and their financial advisor, and kind of has found a way to reduce risk as it associates with venture capital, which is really like hitting one home run and having, 10 misses. They found a way to do that better. And so that's an example, but that's few and far between. When most people think venture capital, they think Sequoia.
Yeah.
And you're not, I'm sorry, folks.
Love you.
You're not going to be able to write a check for less than 20 million to get into the Sequoia
Right.
fund, if they will even talk to you. So, that's my point.
Dan, I think that's I want to go along more with that point of minimums. Let's talk about minimums, right? Globally speaking, within your strategy, et cetera. In the private equity and real estate side, you have minimums from we're technically exclusive within our real estate, but we go from 25 if it's a really small deal to $1 million if it's a bigger deal. And I know that falls all over the map too, but give me your insight to your strategy, those minimums, and then kind of what people should expect when they're finally getting into this alt space.
Sure. So in my space, my model is a full 40 Act model. So there really isn't a minimum. A partner like Vested, it's $100,000 minimum. I also have another partner named Third Wire Asset Management, which is a great solution for people who have accredited investor clients that want a diversified product. So they have a $250,000 minimum, but it's a fully diversified complementary, almost hedge fund of fund product that is aligned with how I build portfolios. So we work very closely with them, and we're doing some white label work with them because it's an excellent product, fully diversified with a minimum of 250,000. Sorry. But then I have another strategic partner, Taze, which is full 40 Act. So, they have great models. They have great alternative product that doesn't have any major minimums, hurdles, any more than your traditional mutual fund, $1,000 or whatever it is. And now with fractional shares and ETFs, you can go even lower than that. So, there's a lot of opportunity out there if you look for it. And I have solutions across the board where I kind of bridge the gap, if you will, is that I'm the only firm that I know of that I have found that plays in both. Most are access platforms that are only private markets, and that's great, but they're just access platforms, and they're only for 30. The average advisor, only about 30% of their book is accredited. We also work with a partner called Leaf Planner, and Leaf Planner helps advisors understand the entire scope of the financial picture of their client, as well as all the important instructions, should somebody pass, really interesting and holistic approach, which may help advisors discover that a lot more of their clients actually are accredited or qualified, because they have a fuller picture of their entire landscape of financial information. And so we work with Leaf Planner to help advisors discover if they have even more people in their book that would qualify. But these are the different things that we try to do to help our advisors gain access to the clients and figure out which one of our partners or if my model will work. But our goal is really to help them scale and give them access and give them education and give them a dedicated technical expert to help them on the client calls. Because I hear this all the time. I'm sure you can appreciate this. these are complex products, and you need someone who has technical expertise in order to be able to overcome some of the initial objections or confusion that your client might have with these products that are different. And when you can get somebody on the phone to help you talk to your client, and 90% of being a financial advisor is being sort of a therapist and sort of that relationship manager. It's not really managing portfolios so much, but when you can have somebody that can come on board with that technical expertise, who also understands that you have to be a therapist, it can really help facilitate those discussions. Advisor after advisor that I've talked to has said they don't like alts because they don't understand them, they don't have access to them, they're too risky, performance isn't great, and I don't know how to talk to my clients about this. And if it's going to be the one thing that they bring up all the time because they intuitively don't understand it and I don't understand it, I just don't want to keep having the conversation because it's not helping improve the trust between me and my client. It's making me look dumb, and I don't want that. So then when you can bring in a partner like what we offer at Banrion, it solves for pretty much every single negative reason that advisors have stayed away from the space. And at the end of the day, the point you brought up in the beginning, you build wealth with this kind of investment. And so it's going to help you with your relationship with your clients, or you as an investor build your wealth much more. And our goal is to make it accessible. I like to say alts for all, because there's nothing that exists now that would prevent my neighbor from buying alts. What prevents is, lack of education, lack of understanding how to build it, lack of a good technical expert that can speak on these things in a manner that breeds trust instead of, reduces trust. It's all available. It's just a matter of scaling. But I think, in the next 10 years, you'll see that alts are as normal in a portfolio and normal in any discussion of investing as equity and fixed income have been.
Yeah, and I fully agree with that. When you hit upon advisors finally being able to holistically look at things, and it's more about the relationship than it is, the actual investments. We hit upon that all the time because our industry has shifted, and we know this. It's been pounded with fees. We have so much education now that picking your investment portfolio, your traditional side, it's not irrelevant, but it is not something that you need to spend it as expertise on. What we need to know is the emotional side of our clients, so that way we can be on board and understand how they work, which we can lead them to those alts or different concepts and strategies that actually fit them, not this normal 60-40, 4% rule, which that's a different topic. But go ahead.
Yeah, I love that conversation, because one of the things you can do with alts that can actually enhance your relationship with your client is if you know what they value. There's an alt for that.
Yep.
There's an alt for that. You value women in leadership. I can find you 100 funds that only focus on investing in women, microfinancing for women in Uganda. I can find you an alternative product that touches you far beyond, and that's really important. People want to invest in the things that they're passionate about. If you love horses, I swear to God, I could find you an alt fund that has to do with equestrian.
Right.
It exists. You can find anything. If you want to get your children involved in investing, this is an awesome opportunity. Peter Lynch is known for saying, invest in what you know, what you understand, and what you love. Let's go beyond that. Let's help people invest to have impact. Impact investing is sort of cliche, but anything can be impact investing if you know what people are passionate about, what really touches them. And if you want to build your relationship and really strengthen your relationship with a client, wouldn't it be cool if you knew that they loved, supporting women in, poor countries build, wealth for their families or get education? Wouldn't it be cool if you could find them some sort of way to invest in that very thing?
Yeah.
That's cool to me. And That's why advisors should be considering this space. It really can strengthen and enhance their relationship with their clients and really show their clients that they know them and they're not just some stock jockey.
Yeah,
And I think a lot of people forget this. We take for granted that fixed income is just always in portfolios. But if you think about like pre-tech bubble, fixed income wasn't really a thing the masses could do.
Right.
It wasn't until after that where you had like the proliferations of the PIMCOs of the world and all these major fixed income funds became available. And then we had fixed income ETFs. And so then it became so much easier. You didn't need to go and like have $100,000 so you could buy bonds. No less than 40, 50 years ago, the average investor couldn't invest in fixed income unless they went to like treasury.com or they went to their bank and bought
right.
a CD, right?
Yeah.
It was really just rich people who could get fixed income because the average par value of a bond is $1,000, and in order to build a bond portfolio, you need hundreds of thousands of dollars to do that.
Yeah.
So now it's accessible, and I think we take for granted that, fixed income, everybody's always had that, but that's never been the case. So I think alts are now at that point. The point fixed income was, say, early 90s, late 80s. And then very much after the tech bubble burst, did fixed income become completely mainstream. So alts are there, and I'm here for it. And I'm here to help advisors, be ahead of the curve, meet their clients' need, help their clients find things that they can invest in that they're passionate about.
Absolutely. And I'm right behind you, side by side in that fight. And it really comes down to there is value in clients being comfortable and loving where every dollar they have goes. There is more value to that than you can actually put a dollar figure on, in my opinion. And it's not about returns, right? I think the returns thing has been driven by us in our competitive nature to be like, well, I can get you 10% when, she can get you 9%. I believe wholeheartedly clients don't, at the end of the day, that's not exactly what they care about. They care about where's that dollar going? What's it doing? And I feel good that it's doing that. Even if I'm only getting a small return, maybe a negative return, but if that money's going to women in Uganda who can build a business, like that feels good. Like that feel good is way more important than exactly what return I'm getting on that dollar, right?
At the end of the day, we worry so much, advisors worry so much about like the returns. To your point, we drove that. Clients have a goal. Did they meet it or not?
Right.
Because at the end of the day, all your client cares about is, was I able to meet name your goal?
Yep.
Was I able to send my kid to college? Was I able to pay off my house? Or was I able to retire comfortably and maintain my lifestyle? That's the goal. How you got there? Nobody cares that you got them 11% instead of 10 if at the end of the day they get where they want to be. And that is the thing, I think it's become sort of a thing, goals-based. It's always been goals-based investing. Right. It's just, there was a time period where passive worked, and so we had to change the marketing. You know what I'm saying?
Yep.
We had to change the marketing,
right,
because all of a sudden we had to show that there was value in what we were doing because it's goals-based. But it was always goals-based. Your client did not care if you made them $20 million and somebody else could have made them $20,100,000. Were they able to retire and maintain their lifestyle, travel all over the world like they wanted to? Yes. That's all they cared about. They didn't care about nobody wants to die and have like millions of dollars sitting around. Like they want to have had the money and spent the money while they were alive. So the extra doesn't matter. It doesn't matter if, as long as they reached and achieved the goal that they wanted to live their best life.
Yes, absolutely. And that's our jobs. Like as planners, that's our whole job. It has nothing to do with anything else. That's our whole job. And our whole job is to build our network and not live in our little small bubble, right? What I love about the pandemic, what it's done for our industry is we're doing a lot more virtual, like a lot more, which means we can reach a lot more people who are like us or who want to work with us. Industries in the past has just been who's around you. And it's a very slower way of building. Now, we literally can attract people all over the place, the globe, if you will, of people who want to work with you. So therefore, you can reach out and do more of that. So I'm really glad that the pandemic happened for that specific reason. But I also believe the pandemic has pushed alts more so, because people spent so much time being able to dig in and do their own investments, whether it's those stupid ass meme stocks, or they started to control and understand more, and now are wanting to invest in the way.
They had nothing else to do.
They had nothing else to do, which now they're like, well, I can do those things. I don't want to. I don't have time anymore. But I want to be in that world. I don't want to be in, your just normal everyday market role, which is going to highlight alts. And over the next 10 years, there's two things I think is going to happen in our industry. Alts will be beyond mainstream. And us as planners are no longer advisors. We are holistic, and we understand the emotions and where our clients are going mentally well above and beyond educating them on what a Roth IRA is. Like that's just the ends means. That's how we get it done. It's more like, hey, I want to be able to retire. I want to take care of my clients. I know we've said that and we've pounded it, but most advisors do not feel that. They do not know the emotional connection to money by people. That is just not mainstream. And those two things I believe will be.
And that's the thing. Like when I was building my platform, I've always been so focused on those strategic partners and my models and whatever. So when I was approached by that company, Leaf Planner, I mentioned earlier, I was like, where does this fit in? And as I learned more about what they were doing, it actually helps my advisors do exactly what you're talking about, right? Understand the full picture, have that relationship, understand the goals, because there's everything in there from like, if you want to write your own obituary, it's in the Leaf Planner system. And if anything should happen to you, your financial advisor knows who your wife is and who your kids are and who your brother is and how to get a hold of him. And hey, here's the obituary he wrote for himself. Like it's all there. And so from my standpoint, I was thinking to myself, like, if my goal here is to help advisors build better relationships with their clients, this is a perfect fit. Even though like intuitively it didn't make sense at the time.
Right.
Now it's like, if the goal of what Banrion stands for is to help advisors do exactly what you're talking about, we want to give them every tool they could possibly need to do that. And while I'm super passionate about alternatives, it certainly is helpful to advisors to know that maybe 5% more of their clients are actually accredited. They just didn't know.
Right.
Because they didn't have the full picture. And then, better than that, now that you have the full picture, now you can hopefully get more assets. Because now you know exactly where everything is and what they're doing. It's really, thinking about holistically, like the goal of Banrion, I should know the name of my own company.
You should, but sometimes it's tough.
The whole goal of Banrion is to, help advisors stand out from the crowd.
All right.
And doing that through alternatives in a scalable way.
Absolutely. As we get to the end of our hour, what's next? So just launched, right? Obviously. Mm-hmm. Congrats on that one. What's next? What's this next step? What does it look like?
Well, my next step hopefully is to build my network of advisors who leverage the platform. For me, that's the biggest deal right now. That's my key focus, because at the end of the day, if advisors don't want to work with me, then like my entire
it's screwed. Yep.
That's kind of important. My second hope is to be able to launch actual proprietary open architecture products. So hopefully in the second half of the year, we'll be able to launch a Banrion ETF, which I've heard time and time again from advisors that they love my model, but it would be great if they could do single ticker solution, because a couple of the ETFs in my model are fairly illiquid and hard to trade. And you got to start calling market makers, and it gets really complicated really fast, and get like professional traders involved. If you have a one ticker solution, it solves that problem. I envision having some Banrion interval funds in the future, and working directly with my strategic partners to have better access to really interesting products at lower minimums. And that's really the goal, is scalability and access, education, operational efficiencies, all of those things are going to be the key. And hopefully, you'll talk to me in 5 years and Banrion will be synonymous as a leader in the alternative investment space.
Not hopefully, it will be. It damn sure will be. So how does an advisor, for all those advisors out there, how, one, do they get involved, and what does that look like?
It's very simple. We are an outsourced CIO. So we have this incredible tech portal that is basically like an Apple ecosystem for our advisors to be able to access their dedicated investment officer who helps them out. You can put them up on your website as your CIO. You can have them on any client call. You can have them do webinars for you, dinners for you, any sort of client appreciation events. We're here for you. But you also have access to all of our research, all of our educational content, all of the research and educational content of our partners. You can access our partners. We are streamlining the operational process with having streamlined PPMs, so you don't have to do different PPMs for every single partner on our platform. We offer screening tools, and we also provide better categorization in screening. So if you're an advisor and you want to look for to build your own models, right now, Morningstar's categories do not align with the traditional alternative categories that were established by Barclays Hedge and HFRI, and all those other firms had standardized definitions that all aligned with each other. And then Morningstar decided to invent their own categories that don't. So we've done the work to align everything to make it easy for you to be able to run searches across markets. You get access to those data feeds. You get access to our analytical tools. So you get all of that. We have it's sort of a subscription model. We do not charge by basis points because this allows us to be accessible and to grow with you without becoming a greater expense. You're not paying us more because you're bigger all of a sudden. Our goal is to help you get bigger, and we'll never charge you more because you did. So that's our model. We focus on working with advisors that want a true partner. Want somebody they can call on the phone at any time and get the answers that they need, but also have access to tools that allow them to build alternative portfolios. Right now, the average advisor does not have those tools because most of the traditional software solutions can't handle shorting derivatives and the like, but we've solved that problem for you. And it's all in a nice, clean, easy to use, really intuitive platform. So I'm super excited about that. So that's the advisor experience, is one where they log in, they see all the research, all the educational content right up front. They go to the data mart, they can check out any of our strategic partners. I like to say it's the Bumble model. So people who are familiar with dating apps know that Bumble is the app where men cannot message women unless the woman has indicated that they're interested in the man first. That's how our model is. When you see our strategic partners, you can click on them in the portal. You can check out their research. You can even subscribe to their research. But until you say contact me, they can't contact you. And so, we want our advisors to feel like their information's safe and we're not just pimping them out to our partners. That's not the point. We want to curate a list where you can feel confident that these are good partners that are going to work with you and that understand you as an advisor and what your model of business is like. And that's another big negative for the business. Most hedge funds and quote unquote alternative firms have never dealt with advisors, typically family offices and institutions, which are a different animal completely. So they have no idea how to service and help advisors. So we work with our strategic partners to ensure that they can be good, trusted partners for our advisors too. So it's really I really think that we have something special. And I think for advisors to come and work with us, they'll be really, really impressed with everything they get with that white glove, high touch investment officer there for them at all times.
What kind of firm? What size firm? What should they be looking for? Like when they hear this and they're like, hey, I want on board, but who fits the best? Where does it fit the best?
It fits the best with firms who I would say are under $2 billion, probably 50 million and up, who maybe they have a couple investment analysts, maybe they even have like a portfolio manager, but they don't have like a really robust research team, or they're just not technical experts in the alternative space. We'll manage an entire portfolio, including the traditional side, because that's my background, that's our team's background. But these are advisors who understand and see that alts are the future, and they need that technical expertise. That's what we bring to the table. So if you're an advisor and you're between 50 million and 2 billion, that's really our sweet spot. I feel like if you're an advisor over 2 billion, you probably have a pretty big and robust research team with a CIO and senior port PMs and things of that nature.
All in-house, by the way. All in-house. Yeah.
But anything under that, I think, is where we can really be helpful, and where our service can really make sense.
I love it. I love that. What's next for you? Where are you speaking at next? I mean, you speak all the damn time, and you always are at some conference. So what's the next stop for you that people can see you at?
I will be in New York in 2 weeks for the Money Show Global Strategy Summit and Accredited Investor Forum. So I will be there the 19th through the 21st, and I will be speaking about, as they refer to it, as I refer to it, investing like it's 1973, Back to the Future, because much of our current environment is very similar to the 70s, but I'll be talking about how to incorporate alts in your portfolio. In essence, it's a really fancy name for my presentation and what I'm passionate about, which is why you should own alts and how you should do it.
That's fair. There you go. There you have it, folks. The first of many, but the first of this series, really hitting it hard. So reach out. We'll obviously have our socials everywhere and do all the things from a marketing standpoint, but do reach out if you have questions, and you can reach out to me. I'll connect you. Do whatever you need to do in regards to that.
The preceding program was sponsored by Black Mammoth. Any awards, rankings, or recognition by unaffiliated third parties or publications are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Black Mammoth. Information regarding specific awards, rankings, or recognitions is available on the Black Mammoth website, www.blackmammoth.com. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions and securities, or the rendering of personalized investment advice due to various factors including changing market conditions. The information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up-to-date, Black Mammoth do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature and is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Past performance is not indicative of future results.